When markets turn uncertain, one thing almost always happens. Small caps start to fall. Not the index, not the large or liquid names, small caps. Now, this is not random and it is not about bad company. In this video, I will explain why small caps are falling first when markets are turning uncertain and why ignoring this signal leads investors to react late. So, most investors see small cap weakness and assume one of the two things. Either small caps are risky and that is normal, or this does not matter unless the index falls. Now, both these assumptions miss one point. Small caps don't fall first because they are weak, they fall first because they sit at the edge of risk. So, when the uncertainty rises, large investors ask one simple question: how quickly can I reduce the risk? Large liquid stocks offer easy exits. Small caps don't. So institutions reduce their exposure to small caps very early. Not because fundamentals have suddenly changed, but because liquidity matters more when visibility drops. This is risk management, not panic. So small caps depend heavily on confidence. They rely on the future growth expectations, steady capital availability, and investor patience. So when confidence is high, they outperform. When confidence fades, even slightly, they reprice faster. That is why small caps act like amplifiers of the market move. They exaggerate the shifts in the risk appetite. In India, small caps are heavily owned by retail investors. Retail participation means faster reaction, lower tolerance to drawdowns, and price driven decisions. So when institutions reduce their exposure and liquidity tighten, retail fear often accelerates the move. That is why small cap corrections in India feel sharper, even when broader markets look stable. The biggest mistake investors make is waiting for the index to confirm the weakness. By the time the index reacts, small caps have already corrected, liquidity has already dried up, positioning has already changed. So small caps don't predict the crashes. They signal the changing risk appetite. Ignoring that signal leads to delayed decision. Small cap weakness does not mean sell everything. It means reduce overexposure to high risk position, avoid chasing the speculative trades, and demand higher quality and margin of safety. So small caps are not a trading trigger. They are a risk thermometer. Read the temperature, don't fight it. If you want market explanations that help you read the risk before headlines, subscribe to this channel. Because small caps don't fall randomly, they fall first and markets explain why later. Thank you.